How is everybody doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berkowitz. Today, I wanted to get everybody an update on credit unions. You know, what's been happening with credit unions? I've been wanting to do this episode for probably about a month or so now. I kind of had this buildup of headlines and articles and other things on here because there's a lot happening kind of in the credit union space. So I want to run through a number of articles here with everybody, but before we really jump into these, I just wanted to read everybody just some of the headlines of some of the things that have been going on here for the last month or two. So this first one was ICBA. After another credit union acquisition, policymakers must act in 2025. The record-extending 21st credit union acquisition of a community bank this year demands a response from policymakers. ICBA said the following announcement of the latest deal. In a post on X, ICBA said the surge in credit union acquisitions of community banks has reached alarming new heights, and making the case for policymakers to act in 2025 on tax-subsidized credit unions exploiting unfair advantages clearer than ever. Next one is polls shows growing demand for credit union policy reform. ICBA released new polling data showing Americans are growing increasingly uneasy with credit unions' regulatory exemptions and support reforms to policies that arbitrarily favor these tax-exempt financial firms. ICBA, or I should say, according to ICBA's latest polling, the number of U.S. adults conducted by Morning Consult, 69%, including 75% of Democrats and 70% of Republicans, say credit union customers should have the same consumer protections that banks provide, such as those offered by the Community Reinvestment Act. 75%, including 84% of Democrats and 76% of Republicans, say credit union customers should have the same level of protection against illegal discrimination as bank customers. And then 62% say Congress should investigate whether credit unions should continue to be exempt from certain regulations designated to protect fair lending, following reports of racial disparities in mortgage lending at Navy Federal Credit Union. While credit unions continue to violate the limits established by Congress to justify their tax and regulatory exemptions, our latest polling shows the Americans who subsidize the credit union industry are increasingly skeptical of the industry's lagging consumer protections. And then we go on to the next one. Credit unions shouldn't use Wall Street to acquire community banks. ICBA called on the National Credit Union Administration to bar tax-exempt credit unions from using funds raised from Wall Street's investors to finance acquisitions of tax-paying community banks. And this is called the subordinated debt rule. In a letter to the NCUA, ICBA said the agency should curb the abuse of its subordinated debt rule, which allows credit unions to use their tax exemption to raise money from private equity firms to acquire community banks. The rule's impact. ICBA said the NCUA rule does the following: has led to an explosion of subordinated debt issuance by credit unions, rising from $540 million in the second quarter of 2021 to $3.65 billion in the second quarter of 2023. Allows credit unions to sell ownership interests in their credit unions to non-member investors, not their traditional member owners. Has contributed to a cottage industry of boutique investment banks and consultants supporting credit union acquisitions of tax-paying community banks. Reform proposals to address the negative impacts of the subordinated debt rule. ICBA called on the NCU to prohibit any credit union that issues subordinated debt from participating in a merger or acquisition for the next 5 years. Any credit union from issuing subordinated debt for 5 years after completing the acquisition of a community bank. Then go on the next one. Wall Street Journal editorial, tax credit unions. Northwest Federal Credit Union Stadium naming rights deal with the Washington Commanders points to the need for the federal government to tax credit unions, according to a Wall Street Journal column. In his Best of the Web column, Wall Street Journal assistant editor James Freeman wrote, as Republicans work next year to prevent further tax increases on companies that pay federal taxes, they should not ignore outfits that have managed to avoid them. Following the stadium deal announcement in August, ICBA said it is the latest example of how credit unions are violating the limits established by Congress to justify their federal tax exemption. ICBA has repeatedly called on Congress to investigate the credit union tax and regulatory advantages, including in recent op-eds on LinkedIn and an American Banker. And then finally, we had this story of former NCUA official profiles rogue credit union. A new blog post spotlights a growth-focused credit union that has rapidly expanded its footprint and obscured its declining net worth by acquiring smaller credit unions and issuing subordinated debt. The Just a Member post from Callahan and Associates, co-founder and former National Credit Union Administration Central Liquidity Fund president Chip Filson, spotlights Credit Union One, a low-income designated institution in Lombard, Illinois. In the post, Filson notes that the credit union was privately insured until 2022 and has acquired 11 smaller credit unions since, essentially one per quarter, has closed 6 branches and laid off nearly 70 employees during its acquisition spree. Markets itself via stadium naming rights and relationships with Notre Dame Athletics and the Mountain West Conference, stating in its promotions that anyone can join. Facilitates acquisitions through large member-funded payouts to top executives. Approves acquisitions via proxy votes from directors who can routinely reappoint themselves to the board without any member vote. And turns to non-operating gains such as acquisitions and borrowed capital to disguise its poor internal rate of return because it cannot generate a normal operating net income from its own balance sheet assets. So this just kind of gives you a flavor for what's going on right now. There's building, you've got the credit unions running around raising a huge amount of subordinated debt to run around doing these acquisition sprees, whether it's buying other credit unions or buying community banks. But I think what lies at the heart of the issue here, is this idea that credit unions have they don't pay income tax, so they have certain tax benefits over other banks and financial institutions, and I think that is fine as long as you have. Now remember, the idea of the credit union was supposed to be something that, like, the steel mill workers credit union that was going to be open on Monday, Wednesday, and Friday, and it was going to be open from 10 o'clock until 2 o'clock in the afternoon, and it was just and you had to be an employee in order to be a member, and that was it. But now, you got credit unions that are bigger than most community banks out there. I mean, you got credit unions that could be in an area that could be 3, 4, 5, 6, 7 billion in asset size, and they could have 50 branches, 60 branches, 70 branches, and they basically operate just like any other bank would operate. But yet they have this huge advantage because they don't have to pay these taxes. They don't have to comply with CRA or a lot of other regulations that banks have to comply with, and I don't believe that is right. And the polling is now starting to show that in fact that the sentiment amongst people is starting to change as credit unions continue to get very large. Now let's take a look at a couple other articles here real quick. So increasing competitive landscape spurs large credit union deals. And this highlights a couple of big, credit union transactions that are going on. But then you have kind of a chart here, which basically says largest mergers between U.S. credit unions since 2014. And you have a whole slew of transactions here, total assets. Look at this one. This was First Technology FCU, and then bought Digital FCU, and you're merging CU, 11.97 billion in assets. Continuing credit unions now going to have 16.74 billion in assets. Was that really the intention of when credit unions were set up for them to become 16 billion asset financial institutions? I don't think so. And every single one of the mergers on this list here is over $1 billion. And I think and this again is where the issue lies. Now let's move on here. So U.S. credit union growth is actually slowing, though. So after more than tripling its asset base since the end of 2007, the U.S. credit union industry is experiencing slower growth. Now this, to be fair, this article was from November 18th, so it's about 6 weeks old at this point, but total assets increased just 0.6% from June 30th to September 30th, which was the fourth weakest growth rate in the last 40 quarters. In the second quarter, the industry recorded the first linked quarter asset decline in a decade. Bank acquisitions could be a catalyst for accelerated growth. There you go, right there. So the growth in the industry is slowing down. But buying community banks could be the catalyst for accelerating that growth. In other words, if you can't grow organically, grow through merger and acquisition. So the number of credit union bank deals reached an all-time high this year, and those deals are bigger in terms of assets sold compared to prior years. And then let's continue on here because I got a couple more articles here. And then it says, credit union merger activity expected to grow sharply in 2025 and 2026. As credit unions grow larger, the sector's mergers are growing too. The largest credit union deal ever was announced in 2024, and experts expect the deals to only get bigger. The credit union market is consolidating, following the same path as community banks in past years. More assets have been sold by credit unions year to date in 2024 than in the past 10 years, according to S&P Global Market Intelligence. Credit union M&A experts foresee more large credit unions to merge in the coming years as expectations for technology advancement, footprint growth, and abundant capital favor larger institutions. This is unprecedented deal activity among large credit unions. I haven't seen it in my 23-year career. Michael Bell, partner at Honigman LLP, said in an interview. The larger credit unions are 100% active and talking with their peers about mergers of equals, large credit union to large credit union, like I have never seen before. So it's interesting, right? And then we go on here to say the right up to the end, 2024 was an active year for credit union deals for banks. The holiday season did not stop credit union bank deal activity. The final days of 2024 brought 2 credit union bank deal announcements and 1 deal termination. So Handsome FCU announced a planned purchase of the majority of People's Bank's asset and liabilities on December 20th, and Zeal Credit Union announced a planned acquisition of substantially all the assets and liabilities of Gojevic Range Bank on December 30th. Also on December 30th, Atlanta Postal Credit Union and Affinity Bankshares announced a mutual termination of a planned merger. Both parties agreed to the termination following discussions between Atlanta Postal Credit Union and regulators. Even with the nixing of that deal, 2024 was a boom year for transactions. Credit unions purchased more banks in 2024 than ever before and doubled the amount of assets sold compared to the previous record in 2022. The activity contrasted with the still recovering bank-to-bank M&A market, which continues to trail 10-year averages. The slow bank M&A market helped open the door for acquisitive credit unions to use their cash advantage to buy small community banks with attractive footprints, a trend that has existed for years but really flourished in 2024. Credit unions' availability to buy banks has frustrated some within the banking community who cite credit unions' non-tax advantage, and some within the credit union space who fear the loss of credit unions' tax-exempt status. Despite these pushbacks, the deals have continued to grow in frequency and size and are expected to continue in 2025. And you can see there was a total of 21. We look at this chart here, 21 transactions, $10.88 billion, for 2024. I mean, just the largest we have ever seen. I mean, it's just completely dwarfed any other year up to this point. And then finally, I want to share this article here, which says that, could 2025 bring more credit union deals? So banks broadly oppose credit union acquisition of other banks, but these deals are popular nonetheless. As the M&A environment improves, could more credit unions be among the buyers? So the next year is widely anticipated to bring a more favorable environment for bank M&A. Could more credit unions be among the likely buyers? And that's what this article goes into. And basically, what this article says in a nutshell is that there are certain states that are basically going to push back on this. There are certain states that are basically going to say, no, we don't want this. We don't want to go down this road. We want to stop credit unions from buying community banks because of the tax advantages and regulatory advantages that they possess. But it also goes on to say, from kind of a fiduciary standpoint, if you have a bank and you're trying to sell it, and the credit union comes to you and they by far put the best deal in front of you, isn't it your obligation to get the best deal possible for your shareholders? Are your investors and shareholders? That is your obligation as a director and as an executive of that bank. If you're selling, you got to get the best deal you possibly can. And if that best deal is coming from a credit union, it's kind of hard to blame them from making that sale, right? I mean, it's not illegal. There's nothing to stopping them from doing it. And again, they're just trying to get the highest, they're just trying to get the highest return they can for their bank. So, but like I said, I think the bigger thing here, the bigger picture is that, I think credit unions are going to find themselves in a big, they're going to find themselves in a very shifting landscape here very soon, because the bigger the credit unions get, as you have more and more larger credit unions, and as they're just running around buying up banks, really hard to kind of make the argument that they shouldn't be treated at, once they get to a certain size, that they should not be treated the same way that community banks are treating. Like, in other words, if you got a $10 billion credit union and a $10 community bank, why is that $10 billion credit union? Why are they not paying taxes? Why are they not following the exact same regulations that the bank has? In years past, it's always been, oh, well, we're just the poor little credit union. We're $100 million asset credit union, and we can't afford all these regulations and to pay taxes and all this stuff and whatever, blah, blah, blah. Well, that argument really doesn't hold any water anymore. And it's just not, realistic at this point. So I think, so again, if credit unions want to continue down this path, if they want to keep getting bigger and bigger, acquiring banks, raising all this subordinated debt and running around buying other credit unions as well, there's going to be repercussions to this. There definitely is going to be. And if I was in the credit union space, I'd be very worried about losing that tax exempt status. I'd be very worried about having a whole bunch of new regulations come on your back, because that's going to change the game. That is going to dramatically change the game for a lot of stuff. So, but like I said, we'll see. I just thought a lot of that information was really good, and I was just rolling in, and I wanted to put it all together and just put it out there. So, hoping people will find this update very interesting. And again, we're going to see how this all plays out throughout the year. I mean, undoubtedly, we'll see what the first quarter or two here brings in terms of credit union acquisitions of banks. I mean, my guess is that this trend is going to continue. It's not going to stop until maybe some type of regulatory or something in the environment changes, but we shall see. Keep an eye on it. So I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as it really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. If you have comments, and I'd love to hear your comments on this topic, please be sure to leave them down below, because I'd really be interested to hear what people have to say, or what their thoughts are on this particular topic. And make sure to check out some of the other content on the channel, as I put out a lot of stuff that I hope people will really enjoy in terms of the banking and financial services space. So with that, I bid everybody a fond farewell, and I will be back to see everybody again real soon. Thanks a lot.